Central bank. A central bank is a financial institution given privileged control over the production and distribution of money and credit for a nation or a group of nations. In modern economies, the central bank is usually responsible for the formulation of monetary policy and the regulation of member banks. Central banks are inherently non-market-based or even anti-competitive institutions. Although some are nationalized, many central banks are not government agencies and so are often touted as being politically independent. However, even if a central bank isn't legally owned by the government, its privileges are established and protected by law. The critical feature of a central bank, distinguishing it from other banks, is its legal monopoly status, which gives the privilege to issue banknotes and cash. Private commercial banks are only permitted to issue demand liabilities, such as checking deposit. Although their responsibilities range widely depending on their country, central banks' duties and the justification for their existence usually fall into three areas. First, central banks control and manipulate the national money supply, issuing currency and setting interest rates on loans and bonds. Typically, central banks raise interest rates to slow growth and avoid inflation. They lower them to spur growth, industrial activity, and consumer spending. In this way, they manage monetary policy to guide the country's economy and achieve economic goals such as full employment. Most central banks today set interest rates and conduct monetary policy using an inflation target of 2 until 3% annual inflation. Second, they regulate member banks through capital requirements, reserve requirements, which dictate how much banks can lend to customers and how much cash they must keep on hand, and deposit guarantees, among other tools. They also provide loans and services for a nation's banks and its government and manage foreign exchange reserve. Finally, a central bank also acts as an emergency lender to distressed commercial banks and other institutions, and sometimes even a government. By purchasing government debt obligations, for example, the central banks provides a politically attractive alternative to a taxation when a government needs to increase revenue. Example, the Federal Reserve. Along with the measures mentioned above, central banks have other action at their disposal. In the US, for example, the central bank is the Federal Reserve System, the Fed. The Federal Reserve Board, FRB, the governing body of the Fed, can affect the national money supply by changing reserve requirements. When the requirement minimum falls, banks can lend more money and the economy's money supply climbs. In contrast, raising reserve requirement decreases the money supply. The Federal Reserve was established with the 1913 Federal Reserve Act. When the Fed lowers the discount rate that banks pay on short-term loans, it also increases liquidity. Lower rates increase the money supply, which in turn boosts economic activity. But decreasing interest rate can fuel inflation, so the Fed must be careful. And the Fed can conduct open market operation to change the federal fund rate. The Fed buys government securities from securities dealers, supplying them with cash, thereby increasing the money supply. The Fed sells securities to move the cash into its pockets and out of the system. A brief history of central banks. The first prototypes for modern central banks were the Banks of England and the Swedish Riksbank, which date back to the 17th century. The Bank of England was the first to acknowledge the role of lender of last resort. Other early central banks, notably Napoleon's Bank of France and Germany's Reichsbank, were established to finance expensive government military operations. It was principally because European central banks made it easier for federal governments to grow, wage war, and enrich special interests that many of United States founding fathers, most passionately Thomas Jefferson, opposed establishing such an entity in their new country. Thank you.